Hi, I'm Josh Rosner. I want to talk about the Wild West, which I think is actually not considered fully as part of the core of the crisis, which is the securitization markets. We can talk about the banks, we can address the problems with the banks, but at the end of the day, we will not, even if we recapitalize our banks, even if we take sticks and force them to lend, we will have still lost a significant part of the financial intermediation in our economy, which funded over $1 trillion in assets in 2007 alone. The securitization market was a market that frankly was created in 1989. It was built with opacity, with information asymmetry, and at the time where people started to accept that they didn't know what they owned, and they didn't have the ability to quickly understand what they owned, suspicion grew, and they ran for the exits. Capital fled, funding disappeared. And so like a broken transmission, you could have a full tank of gas, but without a working transmission, the car's not going anywhere. And that became a real problem. And frankly, that is the problem that we still suffer in many of the markets that are at the core of our economic malaise. To just give you an idea of the significance here, the securitization market, not the banks directly, but the capital markets funded 50% of all revolving consumer credit at the peak, 20% of non-revolving consumer debt, and 60% of all private label mortgages were funded not by the banks, but through the securitization markets. So again, keep this in mind as we sit here talking about the banks. There's no question that the banks are in need of deep and fundamental repair, but leaving the discussion there is not going to actually solve anything. Give you an example, securitization rates, prime, subprime, alt-A, and seconds. That was the securitization rates. Look where we are. That means that all of that funding is where today? It's all on Uncle Sam. It's all on the taxpayer. It's all through FHA and Fannie and Freddie. That's not a sustainable model. To give you an idea of how big the problem was at its peak, this is the summer of 2007. The rating agencies confer a AAA rating. Theoretically, or historically, AAA was supposed to actually be a benchmark. Okay? Corporates, sovereigns, municipals, residential mortgages, CDOs. Does it make sense that two securities holding the same moniker of AAA should have such enormous variability in yield? Is it any surprise that investors grabbed for those securities? And if you look at the number of AAA rated securities by type in the summer of '07, you had a couple of dozen sovereign nations with the ability to tax their population with AAAs. Yet you had over 8,000 residential mortgage-backed securities that had AAAs. Does this make any sense to anyone in this room? Why did it? Okay? The answer is because the rating agencies were given access to information that wasn't publicly available in the market. Okay? There is a Wild West model working here. To give you an idea, the left side is what a typical equity deal looks like. You have a cooling off period during which there's a prospectus, during which there's a roadshow, during which there's disclosure of information forced by the SEC, which allows investors to do their analysis. The company that's issuing stock exists before the deal comes to market. There's quarterly and annual filing requirements after the initial public offering with material information disclosed. And there's comparability in accounting standards and a requirement of materiality that allows investors to compare two different companies. On the other side, this is a typical residential mortgage-backed security deal. Deals were literally coming to market in hours. You would get a phone call on a desk and it would say, we're doing a deal this evening. Here are the weighted averages of the 50,000 or so mortgages in the deal. Do you want to play? There was no registration requirement, no cooling off period, no SEC standards, no pre-issuance disclosure specific to the collateral. The company actually didn't exist until the deal came to market. Okay? So it's not really a surprise that we have the problems that we have. What does this mean? What should our goals be? Less opacity, less complexity, improved capacity for rational pricing. And by the way, price and value are two different things. Without the ability to assess what you own, you can't value it. Sure, you can price it. We need to be able to have the narrowing of the spread between price and value, and that comes from standardized disclosures and information. We need to create incentives for participants to standardize and ultimately list securities. We need to ease the safety and soundness regulatory burdens that stem from inadequate information and opaque valuation. Issuers need to make basic market-defined disclosures. And you need to create reputation-based incentives for issuers and related parties to build high-quality securitized pools. To do this, we need to have a single language. 3 years into this crisis, we don't have a single standard definition of either delinquency or default, which is amazing. It's absurd. Disclosures, we need timely loan-level data disclosed. Material information has to be updated on a daily or at least monthly basis. Dealers should have to require on a daily basis the disclosure of pricing of all ABS that they traded. That would increase liquidity, reduce market volatility, diminish reliance on ratings, and obviate the need for risk retention that we keep hearing about. So this is astounding, and we don't hear it talked about. In the lead up to the crisis, not a single regulator was allowed to access the information pertaining to their institution's investments in CDOs. They weren't qualified institutional buyers. They were required to be because the contracts required such. So we need a standardized contract. We need to create a fiduciary duty. Right now, part of the big problem in the crisis is that this second lien holder, the subordinated mortgage holder, is typically the bank. About $900 billion of home equity lines and second liens are held by our banks. Those same banks own the servicers who service the first liens for mortgage-backed investors. If the first lien holder is willing to do a 20% principal write-down, which he is because 20% write-down beats a 60% loss that he'd have if the borrower defaults, he needs the servicer to effect that. Well, the servicer is owned by the second lien holder or the big bank. And the big bank knows darn well that that 20% write-down, which would benefit the consumer and benefit the mortgage-backed investor relative to default, is going to wipe out his exposure. Okay? And that's part of what's going on now is we have a conflict. So we need to make sure that the servicer conflict is dealt with. And part of the reason I think we're not doing that is because our banks are massively under-reserved for their second lien exposures. And if we force them to reserve properly, the government would have massive amounts of egg on their face because several of those big banks would be right back in TARP, would be undercapitalized, and we'd be right back where we started. And oh, by the way, it would really call into question the validity of the stress test that we saw last spring. So we don't want to do that. Let's just try and extend and pretend as opposed to address these issues. So solutions, create a single standardized pooling and servicing agreement per collateral asset class. Typically, we had 300 or so 300-page documents that an investor might have to read when he was trying to figure out what he owned. Each one had different contractual provisions. That doesn't make sense for the development of an efficient market. Underwriting risk. Part of the crisis right now, we're seeing putbacks of mortgages that were originated in 2003, 2004 for a missing signature. That's not fundamental to the mortgage failing. And so now you've got people who are unwilling to make a loan because they know there's a risk that they're going to end up having to buy it back at some point for something that had nothing to do with a fundamental flaw. So underwriting risk shouldn't be able to be sold. It has to be maintained. Servicer obligation has to be made a fiduciary obligation, or at least prohibit entities from owning the servicing if a conflict exists. And this is really the most important point. None of this is really part of the news flow at this point. Our government has outsourced the recreation of these markets to the American Securitization Forum, which is highly conflicted. It is run by the issuers, not by the investors. In December, they put out model reps and warranties standards. And if you read them, they are not at all a model or a standard. They're a negotiating point. They put a letter to the FDIC just last week in which they said, investors have generally acknowledged loan-level information is not necessary or helpful for some asset classes. In that case, the volume of information that would need to be provided to comply with such a requirement would exceed the capacity of large institutional investors. Has anyone heard of an investor asking for less information? Wouldn't that violate their fiduciary obligation? This sounds to me like the church in the 1400s with an illiterate population wanting to maintain the illiteracy of that population so that they could continue to sell writs and dispensations, okay, and abuse an illiterate population. And the only thing that solved that corruption of the church was the printing press, okay, and the growth of literacy. And that really needs to be the starting point and the goal here. Thank you.